What if I told you that a metal sitting quietly in your old electronics, your grandmother's jewelry drawer, your discarded solar panels, is now worth more per ounce than it has been in the entire recorded history of human civilization? And what if I told you that China just pulled the pin on a grenade that could blow the price past $100 per ounce, possibly within months? Welcome back. I'm Alex Morgan, and today we're going deep inside the most explosive commodity story of 2026, silver. Specifically, what is happening with Chinese scrap silver, why the spot price has surged to around $96 per ounce and is knocking on the door of 100, who is actually behind this move, what the data tells us about where this is headed, and most importantly, what this means for you. Whether you're an investor, an industrial buyer, or simply someone who pays attention to the global economy, this video is going to matter to you. So stay with me, because this story runs deeper than almost anyone in mainstream financial media is willing to explain. Let's begin with the baseline. As of late February 2026, the silver spot price is hovering around $88 to $90 per ounce in global markets, with scrap silver, which refers to silver recovered from industrial waste, old electronics, solar panels, and end-of-life products, trading at or near $96 per ounce in certain Chinese markets. That's not a typo. We're talking about scrap, not freshly mined, refined bullion bars, trading at nearly $100 an ounce. To put that in context, just 1 year ago, in February 2025, silver was trading at roughly $32 per ounce. That means silver has risen by well over 150% in the space of 12 months. In fact, on January 29th of this year, the silver spot price hit an all-time nominal high of $121.67 per ounce. That's the highest silver has ever traded in dollar terms. Ever. The previous record was set back in 1980, and if you adjust that 1980 high for inflation using today's numbers, it sits at roughly $194 per ounce. So in real terms, silver still has a very long way to go before it reaches its inflation-adjusted peak. That's a data point that should stop every one of you in your tracks. But the rally didn't happen in a vacuum. It was engineered, or at minimum, dramatically accelerated, by a set of structural forces colliding all at once. And to understand those forces, you need to start with one country, China. On January 1st, 2026, China officially implemented one of the most consequential commodity policy shifts in modern memory. The Chinese Ministry of Commerce quietly but decisively reclassified silver from an ordinary commodity export to a strategic material, placing it in the same regulatory category as rare earth elements. What that means in practice is that any company wishing to export silver out of China now requires a special government-issued dual-use export license. And those licenses are not being handed out freely. Under the new framework, only 44 state-approved companies qualify for export licenses. To even be considered, firms must have an annual silver production capacity of at least 80 tons and secure credit lines in excess of $30 million. That immediately and effectively shuts out hundreds of small and mid-sized Chinese exporters who have historically served as key suppliers to global industrial users and refineries around the world. Here's the scale of the problem. China currently controls between 60 and 70% of the world's refined silver supply and over 50% of global silver refining capacity. When Beijing restricts who can export and to whom, it doesn't just nudge the global silver market, it seismically restructures it. One senior commodities trader based in London was quoted saying, and I'm paraphrasing, that a wholesale reclassification of silver as a defense-critical material was essentially the nuclear option. Market participants had expected some tightening, but not this. The immediate reaction when details of the policy became clear was staggering. Silver futures jumped 15% in a single trading session. Lease rates, which is the cost to borrow physical silver in the market, surged to levels more than 30 times their historical norms during certain periods of acute stress. That's not volatility. That's a system under structural strain. Even Elon Musk weighed in. When a post about China's silver export controls appeared on X, Musk responded directly, "This is not good. Silver is needed in many industrial processes." That reaction from the CEO of Tesla, a company that uses enormous quantities of silver in its solar products and electric vehicles, tells you everything about how the industrial world is reading this situation. Now here's where the story gets really uncomfortable for those who want to dismiss this as a short-term geopolitical blip. The truth is, the silver market was already severely broken before China ever tightened its export policy. China just poured gasoline on a fire that had been burning for years. Since 2021, 5 consecutive years, global silver demand has exceeded global silver supply, every single year. In 2025 alone, global silver demand reached an estimated 1.24 billion ounces. Total supply, including mine production and recycling, came in at roughly 1.01 billion ounces. That's a deficit of over 230 million ounces in a single year. To put that in perspective, 230 million ounces is the equivalent of the entire annual silver production of Mexico, the world's largest silver-producing nation. The cumulative shortfall since 2021 now exceeds 900 million ounces, approaching an entire year's worth of global mine production, all drawn down from above-ground stockpiles. Those stockpiles are not infinite. Inventories at major warehouses, including the COMEX in New York and the London Bullion Market Association, have been drained to their lowest levels in 40 years. Let that sink in. 40 years. We are now at inventory levels not seen since the early 1980s, and the deficit is growing, not shrinking. In 2026, with China's export constraints squeezing effective global supply even further, analysts at major research firms project the annual deficit could reach approximately 200 million ounces, perhaps more if Chinese export licenses are slow to be granted or deliberately withheld. There is no quick fix for this. Primary mine supply grows slowly. New mines take 7 to 10 years to develop. Recycling can expand, but not overnight. The math here is genuinely alarming. You might be wondering, couldn't demand just soften? Can't industries find substitutes? Let's be honest about what silver actually does in the modern economy, because this is the layer most financial commentators skip over. Silver has the highest electrical conductivity of any element on the periodic table. It has the highest thermal conductivity. It has the highest optical reflectivity. These are not marketing claims. They are physical facts, written into the laws of chemistry and physics. There is no element that matches silver across all three of these properties simultaneously, which means for many critical applications, substitution is either technically impossible, prohibitively expensive, or requires years of engineering validation. Consider solar panels. Each photovoltaic panel uses approximately 20 grams of silver as a conductive paste that collects and transports electricity. With global solar energy capacity continuing to expand at record pace as countries race toward clean energy targets, the demand from solar alone represents hundreds of millions of ounces per year. China, ironically, is one of the world's largest manufacturers of solar panels and a massive consumer of silver domestically, which is precisely why Beijing moved to protect its domestic supply by restricting exports. Then consider electric vehicles. Each EV uses approximately 100 grams of silver across its battery management systems, touchscreens, sensors, and electronic controls. Global EV adoption is on track to triple by 2030. The math produces demand numbers that are staggering when annualized. Add to that the surging demand from AI data centers, which require massive amounts of silver in circuit boards and cooling systems. From nuclear power's quiet revival, from the medical sector, from 5G infrastructure, and from defense systems. These are not discretionary purchases. These are structural industrial needs that do not disappear when silver prices rise. They just get more expensive to fill. J.P. Morgan Global Research, which has been one of the more measured and credible voices on this topic, has projected silver prices averaging $81 per ounce across 2026 as its base case, which, given that silver already hit $121 in January and is currently trading around $88 to $90 after a pullback, suggests the bank may already be behind the curve. Their analysis also acknowledges that silver's industrial demand profile makes it fundamentally different from gold, whose demand is driven primarily by investment and central bank buying. There's another dimension to this story that doesn't get nearly enough attention, and it's the growing disconnect between the price of paper silver and the price of physical silver. This disconnect is arguably the most dangerous development in the entire market. For decades, global silver pricing has been largely set by paper markets, futures contracts traded on the COMEX and similar exchanges, where the volume of paper silver contracts vastly exceeds the actual physical silver available for delivery. This system works fine as long as most traders never actually ask for physical delivery. But when they do, when industrial buyers, institutional investors, and sovereign wealth funds start demanding real, deliverable metal, the paper price can no longer reflect reality. That's exactly what's happening right now. Regional physical silver premiums have exploded globally. In China, premiums on physical silver have surged well above global paper benchmarks. In Japan, secondary market premiums have reportedly hit as high as 60% above spot. In the UAE and Dubai, premiums are running around 40%. These premiums are the market's honest signal that physical supply is acutely constrained, while paper prices, which can be temporarily suppressed through derivatives, are failing to clear real-world demand. Some analysts have begun warning that if physical delivery becomes the dominant benchmark for price discovery, traditional futures exchanges may gradually lose control of global silver pricing, similar to what happened in lithium and rare earth markets when physical shortages emerged. Once price leadership shifts away from leveraged paper systems toward physical supply and demand, the prices seen in paper markets could be revealed as artificial floors, not ceilings. So let's talk about the price itself. Is $100 per ounce inevitable? Let's be careful here. Nothing in commodity markets is inevitable. Geopolitics shift, technology evolves, and markets can surprise in both directions. But let me walk you through what the data actually supports. Silver has already traded above $100. It hit $121.67 on January 29th of this year. It has since pulled back to the high 80s and low 90s, which many analysts are calling a healthy consolidation rather than a trend reversal. The structural factors driving the rally, the multi-year supply deficit, China's export controls, collapsing COMEX and LBMA inventories, relentless industrial demand, have not changed. In the bull case scenario, which is increasingly the base case for many serious analysts, a return to and sustained break above $100 per ounce is likely as we move through the second and third quarters of 2026. If China continues to restrict exports, if industrial buyers scramble for physical supply ahead of summer manufacturing cycles, and if investment demand from ETFs and retail buyers reaccelerates, as it did dramatically through Indian and Chinese retail channels in late January, the conditions for a renewed push toward and beyond $100 are clearly present. Some more aggressive forecasters are looking at much higher levels. One major bank has floated a long-term target of $300 per ounce. Advocates for silver as a monetary metal frequently cite the inflation-adjusted 1980 peak of approximately $194 as the real record to beat. And for context, at the current gold-to-silver ratio, which has historically averaged around 60-1, but has spent much of the last decade near 90-1, if gold is trading near $5,000 per ounce and the ratio compresses to its historical average, silver's implied price would be around $83. If it compresses further toward 50-1, the implied price exceeds $100. This ratio-based analysis gives a completely independent route to justify triple-digit silver. Intellectual honesty demands we also look at what could push silver lower, because risks are real, and anyone who tells you the path is a straight line upward is not being straight with you. First, China could modify or soften its export licensing regime. If Beijing decides the economic cost of restricted silver exports, including impacts on its own manufacturers who export solar panels and electronics that require silver, is too high, it could quietly ease the licensing requirements. Any such signal would likely trigger an immediate sharp pullback in silver prices. Second, a global recession scenario would dampen industrial demand. If tariff wars escalate further, global trade contracts, manufacturing slows, and demand from the solar, EV, and electronics sectors compresses, silver's industrial demand pillar weakens. The metal would still have monetary demand support, but the industrial demand premium could compress. Third, there is always the risk of a broader risk-off sell-off in financial markets. Silver, despite its industrial character, still correlates meaningfully with investor sentiment. If equity markets suffer a severe correction and liquidity becomes scarce, investors sometimes liquidate precious metals positions to cover losses elsewhere, as happened briefly in March 2020 before the rebound. Fourth, recycling and urban mining could surprise to the upside. At $96 per ounce, scrap silver is enormously profitable to recover. Dormant recycling operations are being reactivated, urban mining of e-waste is being fast-tracked, and previously uneconomical silver deposits are becoming viable. Supply is not completely inelastic, it responds to price. But the key word is time. These supply responses take years to fully materialize, not weeks or months. What we are witnessing in early 2026 is not a standard commodity cycle. It is a structural repricing of silver's role in the global economy. For most of the past 40 years, silver was treated primarily as a monetary relic, with some industrial applications on the side, frequently overshadowed by gold, and often dismissed by mainstream investors. That era is over. Silver is now entering what analysts are calling a triple identity moment. It is simultaneously an industrial necessity, a monetary metal, and a strategic resource. China's decision to reclassify it alongside rare earths is perhaps the clearest possible signal from a geopolitical actor that silver is no longer an ordinary commodity. When the world's second-largest economy places a metal in the same strategic category as the elements used in fighter jet engines and missile guidance systems, the market eventually has to take that seriously. The paper promises of the old silver trading system are being tested against the hard limits of geology, industrial necessity, and geopolitics. And as Bullion-Star and other market participants have noted, physical ownership of silver is now carrying a premium that paper ownership simply cannot match. So where does all of this leave us? Silver scrap is trading around $96 per ounce in China. Spot silver is hovering in the high 80s to low 90s globally. The all-time nominal high of $121 was set just weeks ago. The structural deficit has now run for 5 consecutive years, with no sign of reversal. China has weaponized its control over silver supply in a way that the market did not fully anticipate. Industrial demand is locked into a long-term upward trajectory that is embedded in the global energy transition and the digital economy. And the physical market is sending distress signals, in the form of surging regional premiums, that the paper price is not yet fully reflecting. Is $100 per ounce inevitable? The word inevitable is dangerous in markets, but the data is telling us that the structural forces in silver's favor are not temporary. They are not based on speculation. They are grounded in geology, in policy, in chemistry, in industrial reality. Whether the next leg up happens in weeks or months may depend on geopolitics, on Federal Reserve policy, on broader risk sentiment. But the direction of travel for silver, when you look at the full picture, is clearer than it has been in decades. I'm Alex Morgan. If this analysis helped you think more clearly about silver and what's happening in global commodity markets right now, please like this video and subscribe to the channel. It genuinely helps me keep producing research-driven content like this. Drop your thoughts and questions in the comments below. Are you bullish, bearish, or still on the fence about silver in 2026? I read every comment. Until next time, stay curious, stay informed, and always do your own due diligence before making any financial decisions.